Welcome to a clear-eyed valuation reality check on the AI boom. On Professor G Markets, hosts Scott Galloway and Ed Elson sit down with Aswath Damodaran, the NYU finance professor known as the Dean of Valuation, to break down what the latest big tech earnings actually reveal about the AI race. Damodaran's message is blunt. The companies pouring hundreds of billions into artificial intelligence have, so far, no clear picture of how that spending pays off. He walks through why he's increasingly worried about the Magnificent Seven's AI capital spending, how he values the hyperscalers, why he sold out of Nvidia entirely while holding on to Microsoft, and how much of the AI risk is already baked into prices. It's a disciplined, numbers-first take from someone with no ideological stake in the outcome. As always with a discussion of specific stocks, none of this is investment advice. It's one valuation expert's reasoning, laid out so you can weigh it yourself. Big tech has no idea how AI pays off. Damodaran's central observation is a mismatch in time. The spending on AI is happening right now, at enormous scale, but the earnings that are supposed to justify it live entirely in the future, and nobody, including the companies themselves, can yet describe how those earnings actually arrive. Big tech, in his framing, is making a colossal bet on infrastructure without a credible model of the payoff. That's not a claim that AI is worthless. It's a claim that the capital is being committed far ahead of any evidence about the returns, which is precisely the condition under which investors get hurt. The burden of proof, he argues, sits with the spenders, and right now they can't meet it. The big market delusion. To explain how a whole industry can collectively overspend, Damodaran reaches for a concept he coined, the big market delusion. It describes a recurring cycle in which a genuinely large new market attracts so many entrepreneurs and investors that each one quietly assumes they'll capture the majority of it. Add up everyone's implicit market share assumptions, and you get a total that far exceeds 100%, a mathematical impossibility that the market briefly prices as if it were true. The AI frenzy, he argues, shows the classic signs. Dozens of well-funded players, each valued as though it will be the dominant winner, when by definition most of them cannot be. The delusion isn't that the market is small, it's that everyone thinks they'll own it. The trillions problem. Damodaran puts a number on the gap. To justify the capital currently being poured into large language models, he estimates the industry would collectively need to generate 2-3 trillion in revenues eventually. That is not a typo or a stretch figure. It's the scale of recurring revenue required to earn an acceptable return on the data centers, chips, and energy already being committed. And it isn't revenue that exists today. It's revenue that would have to materialize at massive margins across the whole ecosystem. When you hold the present spending up against the future revenue it implies, the arithmetic simply doesn't close, which is the quantitative heart of his skepticism. Who ends up holding the bag? If the math doesn't work, someone eventually absorbs the loss, and Damodaran is specific about who. As an investor, you're going to get eaten alive if you go into that space, he warns, and the most exposed, in his view, are venture capitalists and the private markets. They are the ones funding the long tail of AI startups at valuations that assume everyone wins, and they are the ones most likely to be holding the bag when the correction arrives and the market re-rates those bets toward what the fundamentals can actually support. It's a pointed message for anyone allocating into private AI names on the assumption that public market enthusiasm will bail them out. Why he sold Nvidia. Damodaran is careful to separate a great company from a great investment, and Nvidia is his case study. He calls it a company that delivers, no argument about the business. But he has fully exited his position, completing the sale at the end of last year after unwinding it in a staggered fashion over 4 years. The reason is price, not quality. It is richly priced, he says. You need too much to go right to break even. In other words, the current valuation already embeds a near-flawless future, leaving essentially no margin for error. When a stock is priced for perfection, even excellent execution can produce a poor return because all the good news is already in the price. Architecture versus application. He does draw an important distinction about where Nvidia sits in the AI stack. Nvidia is on the architecture side of the boom. It sells the picks and shovels, and it keeps the cash whether or not its customers' AI bets ultimately succeed. That makes it structurally safer than the application layer companies betting on specific AI products. But safety of business model, Damodaran stresses, is not the same as safety of investment. Even the best-positioned player in the value chain becomes risky when its price assumes that the entire boom beneath it plays out perfectly. The architecture layer keeps the cash, but at today's valuation, it still leaves him no room for the many things that could go wrong. Why he keeps Microsoft? The contrast is Microsoft, which Damodaran continues to hold, because its path to justifying its valuation strikes him as far more plausible. He characterizes the cloud business as a utility, something essential to modern economic life, generating stable, recurring demand that a pure-play AI chipmaker simply can't match. I don't need as much to happen to justify keeping Microsoft in my portfolio, he explains. The bar for Microsoft to earn its price is lower and more grounded, because the company already has a durable, cash-generative engine that doesn't depend on the AI story paying off on schedule. He's also candid about a very human factor. As a California resident, the large capital gains tax he'd owe on a long-held position gives him an extra, real-world reason to keep it. How much AI risk is priced in? A recurring thread with Galloway and Elson is how much of this risk the market has already absorbed. Damodaran's worry about the Magnificent Seven is that their prices increasingly assume the AI capital spending will convert into commensurate profits, and that assumption is doing a lot of work. When the market prices a group of companies for a future that requires trillions in new revenue and a handful of clear winners, it has effectively priced in success and left little cushion for disappointment. His concern isn't that AI fails outright. It's that the spending accelerates while the evidence of payoff lags, so the risk of a re-rating grows precisely as enthusiasm peaks. Pricing versus value, the discipline. Underneath every specific call is Damodaran's core discipline, and it's worth stating plainly. A stock's price is not its value. Price is what the crowd will pay today, driven by mood and momentum. Value is what the cash flows justify. His whole method is to translate a company's story into numbers, revenues, margins, reinvestment, risk, and then check whether the price the market is charging can be defended by any reasonable version of that story. Applied to AI, that discipline is what lets him admire Nvidia's business while selling the stock, keep Microsoft on grounded logic, and question sky-high private valuations and even a name like SpaceX without emotion. The lesson for investors isn't avoid AI. It's to insist on the arithmetic, to know what has to be true for today's price to make sense, and to ask honestly whether it is.